Welcome to Chapter 13, where we dive deep into the complex but fascinating world of group audits. Now, as you move through this section, our primary goal is to master the audit of consolidated financial statements. This is a high-weightage area, so let's approach it with focus and confidence. Let's get started. First, we'll start by breaking down the core concepts of consolidation and clearly identifying who is responsible for what specifically, the roles of the parent company and the auditor in bringing these financial statements together. As we progress, we will explore the critical audit considerations you need to keep in mind when dealing with group structures. You'll also learn how to distinguish between permanent consolidation adjustments and current period consolidation adjustments, which is a vital technical skill for any aspiring CA. Finally, we will cover the reporting requirements for various scenarios and look at how to handle group financial statements, including the essential process of coordinating with component auditors. To tie everything together, we will interpret Standard on Auditing 600, which focuses on using the work of another auditor. Now, let's dive into a very practical scenario involving CA Muted, who is the statutory auditor for a manufacturing company. This case is a perfect example of how we must integrate the Companies Act with accounting standards during an audit. In this scenario, Muted discovers that his client, an Indian company, has purchased all the shares of a company based in the USA. This immediately triggers a critical question. Does the Indian company now need to prepare consolidated financial statements? First, Muted looks at Section 129 of the Companies Act, 2013. Since the Indian company has acquired all the shares of the U.S. entity, it now has a wholly owned subsidiary. Under the law, when a company has a subsidiary, it is required to prepare consolidated financial statements to give a true and fair view of the group's financial position. But here is where Muted had a recurring doubt. Does this requirement apply even if the subsidiary is located outside India? To answer this, he turns to IND AS 110, which specifically deals with consolidated financial statements. The guidance here is very clear. A parent company must consolidate all of its subsidiaries, regardless of whether they are domestic or foreign. So, the conclusion is straightforward. The Indian company must consolidate the US-based subsidiary. As an auditor, your role here is to ensure the management is aware of this requirement and that the consolidation process is handled correctly. As we move forward, keep in mind that this leads us into deeper audit considerations, such as the responsibility of the parent company auditor and the application of Standard on Auditing 600, which guides us on how to use the work of another auditor, especially crucial when dealing with a foreign entity. To start, it is essential to understand what consolidated financial statements actually are. Imagine a group where a parent company controls one or more subsidiaries. Instead of looking at each company in isolation, consolidated statements present the assets, liabilities, equity, income, expenses, and cash flows of the parent and its subsidiaries as if they were a single economic entity. While separate financial statements only show the position of one individual company, consolidation gives us a complete, bird's-eye view of the entire group's operations and profitability. If we refer to IND AS 110, the answer is clear. The results of a subsidiary's operations are included in the consolidated financial statements from the date the parent actually gained control. So, in this case, consolidation begins from the date of acquisition in June. The management then combines items such as assets, liabilities, income, and expenses of both the parent and the subsidiary to create the group's financial picture. However, this is where the audit challenge begins. Imagine an auditor, Muted, who discovers that while the parent company's books are ready, the foreign subsidiary's accounts are completely unaudited. This creates a catch-22 situation. Muted is now faced with a critical professional judgment. How can he express an opinion on the consolidated financial statements if a significant component of that group has not been audited? This brings up vital considerations for any auditor in a group audit. We must ask ourselves, what are the implications of including unaudited component accounts in a group report? And what steps must be taken to ensure the consolidated figures are reliable? This is the core challenge of group audits, balancing the need for a consolidated view with the necessity of verified data from every single component.